Welcome to the Weekly Spark, your fast 5-minute flash of insight into the world of mortgage and real estate. Every week, we're here to ignite your understanding of the market, from mortgage rates and housing trends to legislative updates and insider strategies. So let's strike the match and spark your week. This is the Weekly Spark.
Welcome back to the Weekly Spark. This week, we're going to let you know about a little program that might help out some of your borrowers to qualify for a little bit more. And of course, we can't continue without talking about the elephant in the room. We are recording this on Wednesday, just after the Fed meeting. And Jason, I think you said something about a month ago, and I brought the receipts. So
here's my prediction, Ryan. The Feds will cut rates in September.
Ooh, bold statements. I love when we make bold statements.
So Jason, what happened today at the Fed meeting?
It's always nice to be right, Ryan? So the Feds did cut. And as of the recording today, we just watched the Fed meeting by Powell, and they cut it by 0.25%, which means that we were right, right? But again, you have to remember, the most important thing about this meeting, Ryan, was really the sentiment. Were they going to be dovish, or were they going to be a little bit more hawkish? And what I've seen is that they were kind of neutral. They didn't really talk about cutting more in the future. They said it was really more of a management of risk. So the bond market didn't love it that much. Now, the good news is we've already seen a great uptrend in the bond market, which will show the charts here in a minute. So the rates have already seen a nice downward trend.
Yeah, so I definitely want to just jump to the charts and kind of see the initial reaction that happened about an hour ago now, half hour to an hour ago now. So let's go ahead and take a look at what the initial reaction of the rates was.
Yeah, so initially we were up about 11 or 12 basis points today. And as soon as Powell started giving his remarks on the state of the economy, the market, the jobs market and such, it really took a huge change up to 9 basis points. As you can see, we have an alert to lock here today, Ryan. So this is always a good thing to have when you're working with someone like us. We're constantly watching the market. We know when we need to lock our rates in. But, we see this trajectory. We've been talking about this for a couple of weeks now. We still are in a bullish pattern here, and we are stuck in between these two Fibonacci levels. What we're looking at, Ryan, for the rest of the week is if we can hold that 1.06, I think we may be in okay territory. I'd also want to look at the 10-year Treasury. And again, this is the inverse, right? So as Treasury bonds go in the opposite direction, that means that it's bad for rates. And right now we're up 3 basis points. We've got a lot of room here in between. So we'll just kind of see how it plays out. But, Ryan, initial reaction, not good for rates. But overall, I think long-term we're going to be okay.
Yeah, and generally with that, even at the 20 basis points, you mentioned being up 11, now down 9, that's not a direct 20 basis points on a rate cost. Sometimes it's already priced in with expectation by lenders. Sometimes they'll hold back gains. So a lot of these lenders we're not even seeing, I haven't even really seen a reprice alert showing that the rates are getting worse. That being said, we kind of expected this because, there was the 25 basis points essentially priced in, like we've been preaching for, 3 weeks now, like, hey, get your rates locked so that we can take advantage of this little window. Is already priced in, and maybe they were a little hopeful for that 50 basis point cut. And so now we're seeing a little pullback from that hope, and that's really what we're seeing. I don't think it's all that much of an impact on rates. So if you're in the process and haven't locked, just call your LO and get it locked. So great conversation there about rates. Like I said, the range bound stuff, we'll see how that plays out. As far as a loan program goes that we wanted to talk about, I talked about it a little bit last week by myself. This kind of cements that for me, where adjustable rate mortgages are going to be truly back. So tell me a little bit about what you know and why somebody should choose an ARM maybe over a fixed rate for 30 years.
Yeah, so realtors, this is a good product to have now because we're kind of normalized in terms of the yield curve inversion. And what that means is the 10-year and the 2-year kind of flipped, where the short-term rates were actually higher than the long-term rates. So we're finally seeing that normalization coming back in the market. So what does that mean? Well, that means that if you have a borrower that qualifies for a regular conventional or FHA loan, you can put them in a 5 or 7 year ARM, which means they're fixed for 5 or 7 years. They also have a 10-year ARM as well. We're seeing the best pricing on 7-year ARMs right now. So if someone has the risk tolerance to do that, we're seeing interest rates about 0.5 point or more lower than the average that you would get on a regular 30-year fix. So really a great product to talk to folks that have that risk tolerance and want to be in a loan that maybe they are okay refinancing or know they're not going to be in a loan for that long.
Yeah, and we've talked about it. Generally, the average person stays in their loan for about 11 years. However, in the recent environment, we've seen that change quite a bit, and we're seeing refinances within 1 to 2 years pretty often. And I would say the large majority of our people are either buying a new house or going ahead and refinancing to save them some money in that time frame too. So great insight there. I appreciate everything you brought today, Jason, and looking forward to hopefully more rate cuts next month. Have a good one.
That's a wrap for this week's edition of the Weekly Spark, brought to you by Creative First Mortgage. If you've got questions or want us to cover something next week, please let us know, shoot us a message, and until then, keep your deals moving and keep your week lit. See you next time.